Good evening. I'm Shervin Joseph with Fitzgerald Financial, a division of Town Bank Mortgage. And it's my pleasure to do this episode tonight. And we've been on for this would be the fourth week. And this is a 4-part series of home ownership, home buying, everything you want to know about credit. And along with Sean Higgins from United One, I have been doing this 4-part series with him. So we look forward to, enlightening you and closing the wealth gap, hopefully with our literacy training. And hopefully you've attended the last 3 episodes and you've gotten something out of it. And I hope tonight that you would get something out of it. I thought Sean was there. And there you are. Higgins. Yes, so I hope that you get a lot out of it. Sean and I have been doing this, and if you've been on, you've heard this before, and if not, we've been doing these type of literacy trainings for approximately 16, 17 years. And truth be told, we love doing it because we know it makes a difference, it makes an impact, and anything we could do to contribute to reducing the gap in home ownership and increasing the opportunities for folks to have wealth and to develop wealth. It starts with home ownership, the biggest step you could take towards wealth. So with that said, we're going to start tonight and get right to it. Sean Higgins is Senior Vice President with United One, and he'll explain what he does. He's not a credit repair person. Please understand this. He's not a credit repair. What he is the expert with everything credit and everything with regards to FICO scores. He works with us as he works with many lenders, and he helps lenders by proxy. He's helping customers increase their credit scores and ensure that they have an opportunity to qualify for a mortgage. So, without further ado, Sean Higgins.
Thanks, Shervin. As usual, great to see you. Glad to be a part of whatever you've got going on, presenting to groups with a goal of creating more home ownership. So I'm going to put my presentation up on the screen. As Shervin said, my name is Sean Higgins. I'm with United One Resources. I'm based in Pennsylvania. Been doing this for 31 years now. And we're, as Shervin so eloquently said, we're not credit repair. We're a credit reporting agency. We sell credit reports to lenders. And as part of our service, we help lenders look for opportunities to improve credit scores with the credit bureaus. We have a simulator tool, which you'll hear me talk a little bit about, that we use in the process to identify opportunities for improvement. And the thing that I'd like to stress most, besides that we're not a credit repair agency, is the best place to get started in this whole homeownership journey is with the mortgage loan officer. And I truly hope that you reach out to Shervin, because he'll start with the credit report. He'll engage us where needed. He's a very sharp mortgage loan officer as it relates to credit score improvement, been doing it for a long time. And that's just a little bit about what we do. So with that said, I can get started, take you through a little bit of information on credit scoring. So credit scoring, by definition, it's the measure of the risk of default. And currently in mortgage lending, we use a FICO score version 8. It's a score that's appended to 3 major credit bureaus, which are TransUnion, Experian, and Equifax. And a credit score is calculated based on the information that's in the file right now. So if we were to pull a credit report right now on a consumer, chances are we'd get 3 different credit scores per credit bureau. And the reason is because there's unevenness of the time of reporting of the data. But for the most part, all the information is the same. It's just that it hits the credit files of the credit bureaus at different times. Sometimes there's going to be some errors in credit reporting. And you'll hear me use a term called credit fitness. And credit fitness is really just an awareness of what's in your credit file. And there's 2 really good tools that'll help you become more credit fit or more credit aware of what's going on in your file. And I'm going to discuss that tonight. Okay, so the score ranges They range from 300 to 850. Anything above 700 is considered to be an excellent score. Our point of entry in the process is trying to improve scores from sometimes in the low 500s up to the mid 600s so that they could qualify for mortgage. That's really Shervin's area as far as what the scores need to be successful in applying for a mortgage. But generally speaking, our point of entry, as I said, is usually in the 5s to the mid 6s. As an aside, I've only seen a handful of people with credit scores in that 850 range, which is considered to be a perfect score. So not a lot of them are out there walking around, but there are a great amount of the population has good credit scores. Okay. So people always say, what actually goes into a credit score calculation? So as I said at the beginning, it's the FICO score that we use in mortgage credit. Okay. And FICO is very both deliberate and secretive in their process. They use an algorithm, which they don't share with anyone. Okay. But they do share the ingredients. And the ingredients of a credit score are made up of payment history, the amounts owed, the length of the credit history, any new credit, and a credit mix. And as you can see from looking at this chart right now, the two largest factors in the credit score are the payment history and the amounts owed. Payment history, obviously, if you're paying your bills on time, that's going to have a very positive impact. The amounts owed, that really relates to the balances of your credit card accounts as it relates to the available credit. So for instance, if you have $1,000 limit on your credit card and you're up around $800 or $900, utilization is the term they use in lending, it's going to have a little bit of a negative impact. So what we always like to tell people, and I'll touch on this in a little bit, is try to keep those balances below 20% of the available credit. That'll help your score perform. So if you've got those two things nailed, paying your bills on time and keeping that utilization below 20%, you're doing the majority of the heavy lifting right there. The length of the credit history, the credit mix, and the new credit, they're less of a factor. And as I said, with these larger factors being payment history and amounts owed, those are where the opportunities are to lift the score. Okay. So where does it all start? It starts with a credit inquiry. So when you make mortgage application with Shervin, that's considered a hard inquiry because that follows a credit application. So hard inquiries are used in connection with an application for credit. The credit report is accessed with the consumer's approval. The other types of inquiries that are out there are called soft inquiries. And a soft inquiry is used in two different ways. One is in an existing account relationship for credit review purposes. That means, for instance, if you are have a credit card account with a lender, chances are when you filled out all that fine print to get your credit card, there was something that listed the credit grantor having the right to look at your credit report once a year for a review. That's a soft inquiry. The other side of soft inquiry is when consumers are selected for pre-approved offers of credit. For instance, when you get those credit card promotions or home equity loan promotions or whatever type of loan promotions in the mail, that is generated from a soft inquiry. You fit a certain criteria and the credit bureaus sold your lead and you received a firm offer of credit from one of those companies. Soft inquiry. Very different, but as you can see, the consumer's in control of the hard inquiry, which is very important. People ask all the time, if I have a credit report, if I give consent to have my credit report pulled, what kind of impact is that going to have on my credit score? Okay, there's a lot of myths out there. There's a lot of different thoughts. But the truth is it's going to be a 5-point reduction in your credit score, and it's going to happen about 30 days later. However, if you are out there shopping, say, for a car, and you go to a couple of different dealerships looking for a certain type of car, different model car from the manufacturers, there's a good chance that your credit report is going to get accessed multiple times. So as long as that type of work is done within a 14 to 30-day period, and I say 14 to 30 days because two of the credit bureaus consider it in a 14-day period and one considers it in a 30-day period, they're going to be treated as one inquiry. So as a rule, that 5 points will only happen once as long as that's happening in a tight time frame. Now, FICO does tell us that consumers that are out there with more than 6 inquiries into their credit report, are 8 times more likely to declare bankruptcy versus people that have no inquiries. And why is that? Because the way the algorithm is built, number one, and the suggestion is that if someone's out applying for credit, chances are they're in serious need of credit, maybe as a lifeline. And all their statistics and studies have indicated that someone in that space is more likely to be bankrupt. Okay, so inquiries, take away from that, 5 points, 30 days, not a lot to worry about. So people say, how do I improve my FICO score? Well, as I said earlier, pay your bills on time, keep those credit card balances low, and only apply for credit and accounts as needed. Okay. If you do have issues with your credit report, your credit score, all is not lost. A true professional like Shervin will help you through that process with the tools that and his knowledge and experience on how to improve the credit score. So as I said in the very beginning, I was going to talk a little bit about credit fitness. The first tool that I always recommend in credit fitness is go to annualcreditreport.com. That's a free service. And a consumer can have their credit report, access their credit report once a week through the rest of 2023. Since we're coming out of the COVID period, that was something that was made available and it's been extended through this year. Annualcreditreport.com. You can see each of your 3 credit reports. It will not have a credit score. And there is going to be a couple of challenge questions to make sure that it's not someone trying to improperly access your data. So you have to be on your toes a little bit when you're making that account inquiry. Just make sure that you know previous addresses, previous bank relationships that you may have had for loans, or even a previous payment. Annualcreditreport.com. 5 factors that drive your scores. Anything that's currently late, anything that's been recently late, high balances on those unsecured credit cards, any kind of public record information that's derogatory. And quite honestly, a lack of open trade is going to have a negative impact on your score. Pretty much the converse to what we discussed as far as what will improve your scores. So here's 5 ways you can improve your credit scores. Obviously, you have to have your credit report first, but a common item that we see is someone may have been a little bit slow in paying a revolving credit account. If you've got a recent late, that's probably going to hit your credit report for about 50 points. And what we found is oftentimes these credit grantors, so think store credit cards, Macy's, JCPenney, those types of people that have a deeper relationship with you because you're buying goods directly from them and you're opening an account with them. We've seen many, many times where if there was a one-time late and it truly was a mistake or an oversight and that credit grantor is contacted, there's a good chance that they're going to give that courtesy removal, a one-time courtesy removal. A couple things they'll take into consideration are how often you've been current and the length of the relationship. So that is always something we advise a consumer to do. If there's a collection account on a credit report, that collection account, as I've said many times, is only on that credit report to be used as a hammer to make you pay your bill. So since it shouldn't be there, and the goal is to get you to pay, we advise people that when they're dealing with the collection agency to make an offer of payment only if they will remove the account from your credit reports upon payment. A lot of success with that. As I said earlier, keep those balances below 20% of your credit limit on your revolving. Another item that we see quite a bit is student loan late payments. So student loans are serviced, and the servicer may not have the most current information. There's been a lot of students that were able to put their student loans into deferment for one reason or the other, and maybe the servicer has it improperly reflected on your credit report. It's a pretty simple fix, but once again, you got to be aware of what's going on with your credit report to know what's going on and how the servicer is actually reporting it. That's an easy fix, as I said. It just takes a little bit of time on the phone with the servicer, supply them proof of the status, and chances are that late will come right off. Installment loans, we never advise anyone to pay an installment loan off soon. It just doesn't have a positive impact on the credit score because it's a scheduled payment and there's really no win there. Shervin will say in his presentation that it makes a lot of sense to take that money and apply it to other things that may make more sense to improve your score. upon the advice given by the loan professional. Okay. Second credit fitness tool that I recommend is Credit Karma. So there's over 100 million people in the United States have Credit Karma accounts. It's a wonderful, wonderful tool. The only thing is there's a couple of things that are different versus what they're going to use in the mortgage process. Credit Karma is not used presently in the mortgage process. The Credit Karma score is made up of Equifax and TransUnion. Experian is not included, whereas the FICO score that we use in mortgage uses all three bureaus. The ranges are the same. Score factors are different, as you can see on the screen there. Credit Karma will consider rent and utility bills in the process, whereas FICO won't. Here's the takeaway that you have to remember. The Credit Karma score is probably going to score on average 30 points higher than the FICO score. So when you're applying for a mortgage and you've been a great credit fitness person and you know that your score is, say, a 750 on your Credit Karma, and the loan officer pulls your credit report and they say you're a 720, a sharp loan officer will be able to reconcile that for you and explain to you that that's the way it is. It's not individual, it's broad, and we've seen it time and time again to know that that's a good number to put out there in our presentations and advise consumers. So once again, Credit Karma, it's a great credit fitness tool. However, the score is going to be a little bit higher, and our experiences are 30 points higher, and that needs to be taken into consideration in any conversation in the loan process. Okay. Medical collections. Medical collections were a big problem in the lending world as it related to the credit report, specifically the credit scores. So last year, just about this time, any paid medical collection debt is now going to be removed from a credit report. There were a lot of instances where people would good faith pay their medical collection bills to zero, but the collection agency wouldn't remove it. We could never understand why they wouldn't remove it because it didn't belong there in the first place. However, the credit bureaus got together and they said, no more. So that's probably worth 50 points to your credit score, the fact that that will not be there. So it's an incentive to deal with these people, get those collections paid, negotiate it and paid, and get them removed. Also, a year ago, the time period to report a collection, a medical collection that is, increased from 6 months to a year. So it gives you some additional time as a consumer to work out that process with that medical collection agency before it actually gets reported to your credit report. And also at the beginning of this year, medical collections, any medical debt that was going to result in a collection had to be at least $500 to be reported on a credit report. In the past, it was very common to see $50 and $60 and $70 balances being reported. Now it's got to be at least $500. So that's a great positive impact, and that's probably helped people's scores by at least 50 points. Okay. There's going to be some big changes in credit reporting in 2024 and 2025. So FHFA, they oversee Fannie Mae and Freddie Mac, and they've made some changes for any loan that's going to be securitized by Fannie Mae and Freddie Mac. And VA and the FHA and VA loans are expected to adopt the changes. 2024, FHFA said that you could use 2 credit reports instead of the 3 that they're being used right now. Okay. There has not been any guidance provided on which 2 credit bureaus, but the information that we've received in our industry is 2 credit reports instead of 3. Also, in 2025, FHFA is going to change the scoring model. So I said at the very beginning of this presentation that we're using the FICO Classic or the FICO 8 right now, as it's known. In 2025, there's going to be 2 scores per credit file. One is the FICO 10T, which is Fair Isaac's product, and the other is the Vantage 4, which is the same credit score that's used in Credit Karma. Okay, there's going to be a change so that there's going to be multiple credit scores per credit bureau, whereas the current process is one score per credit file. The current score process is to use the middle or the median score per applicant. The future process with the 2 credit scores per credit file and 2 credit bureaus per applicant is going to be the average credit score. That's going to be a big change. It's going to probably start making its way into the news in the next months because of 2024 with the move from 3 files to 2 files, and then later in 2024 with the onset of 2025 bringing us the credit score changes. So those are some changes that are coming to the credit scoring and credit reporting business as it relates to mortgages. Okay. Just to sum everything up, there's some websites for you with each of the credit repositories. Pretty straightforward as far as getting in touch with them. Annual credit report, which I did talk about earlier. And then also one of the things I like to mention in all my presentations is I think it makes a lot of sense as a consumer to log on to optoutprescreen.com and have your name taken off the marketing list for pre-approved offers of credit and also trigger leads. It's very, very prudent to do this. And the main reason that I suggest this is twofold. One is a lot of identity theft that we've seen in our business start with someone's mail being lifted and someone taking their pre-approved offer of credit and going out and stealing their identity. It happens all the time. We get calls in our office all the time. And then obviously the other part of it is a trigger lead. Right now, the credit bureaus will sell your lead information if you do make an application for various types of loans, and you'll be bombarded by people trying to sell you something that you quite honestly don't need. So that's my presentation. I'm glad to answer any questions in the chat if anyone has any, but it's been a real honor to be a part of this process for the last 4 Tuesdays. And as Shervin so eloquently said at the beginning, our goal is to promote home ownership. So we hope we've reached some people and we hope we can help you. Thank you.
Thanks a lot, Sean. As usual, highly professional, elite information, just an expert in the industry. And Sean hit it right on the head. One, and as I said earlier, he is not credit repair. What we do, though, we'll give you a simulator, if you are in trouble with regards to your credit, if, at loan application, getting pre-approved, we'll give you a simulation that will assist you in increasing your score. And the money that it costs for one of these credit repair folks is the money that you could use to pay your debts down or contribute towards your closing costs to help you purchase a home. Or you could just use it to invest elsewhere, because it's not cheap using these self-imposed credit repair folks. So that's just my opinion, not a very strong one, as you could see, with regards to those folks that do it. I just think that they take, there's a place for that, I'm sure. I'm not condemning all of these entities. However, I am saying that I think folks, if they wanted to do it on their own, could save themselves a bundle of money. Now, I will get started and bring my presentation up, and we'll get started. Because this is our last episode for the 4-part series, and we've been doing this since last year, and we've done it pretty much every quarter. I wanted to go back, even though I did this one last week. I'm going to do Mortgage 101 again for those that weren't here, for the new folks that might be listening. So I'm Shervin Joseph, Fitzgerald Financial, which is a division of Town Bank Mortgage. Now, Town Bank was recognized by Forbes magazine last year as the number 9th performing bank in the country out of, about 5,000 banks. And so it tells you that our credibility is high. And we're pretty strong. We're all around the Beltway, Fitzgerald Financial Group. And we know the business. Our underwriters are in-house. Our processors are in-house. So you're not calling in the Midwest to find out the status of your loan. And the underwriters live in your community. So they know exactly what they're dealing with, what you're dealing with, and what you're trying to accomplish. Nonetheless, we'll get started, and we'll start with why choose us? And that's always going to be, when you start looking for mortgage companies, who should I go to and so forth. Well, we tailor make loans for your needs. You'll have a personalized concierge, which is me. And I have 37 years in the industry. I'm a former Marine. So the 37 years in the industry, I've held just about every position in originations. So you would be in good hands. We have competitive and we're very competitive rates. We're very aggressive as far as price. Um, we close loans on time. Matter of fact, we set the benchmark for closing loans quickly. My team typically, not exceptions, typically close loans in 2 to 3 weeks. That's where Fitzgerald Financial Group is. We set the bar pretty high for closing loans quickly, and that's 2 to 3 weeks after a ratified contract. So if you're thinking of buying a home, you look at the options rent to own. With rent, you have no control over rent increases. You have no tax deductions for rent. There's no privacy when you rent. You have limited ability to personalize the home. In other words, you're not going to be able to do anything with that apartment, or even if you're renting a home, because you have to turn it back into what it was when you got there in order to get your deposit back. And your rent goes up on a monthly basis. With a mortgage, when you own a home, you build equity. You start your process to wealth building. You have tax deduction. You have opportunity to customize your home, and there's a fixed payment option, which is the only type of mortgages. In 37 years, I could tell you that I'm about 99% of my loans have been fixed because I totally focus on fixed. And, thankful that we didn't have to go to adjustable mortgages. We do have them. I just think you have to be wary and so forth. Zero down payment options. In other words, they're 100% loans that are available. Now, are you ready to buy a home? And you ask yourself these questions. Do you have a steady income? Do you pay your bills, including your rent, on time? Do you have low to medium debt? Do you do you have money in your savings account? Do you have the ability to make the mortgage payments? And do you have okay to good credit? And if you're answering yes to just about all of these questions, you're pretty much ready to go. So, without further ado, we'll take you into the process. The number one thing that anyone should do that's interested in purchasing a home is get pre-qualified, pre-approved. Speak to your loan officer, preferably Shervin Joseph, and you want a loan officer with integrity. You don't want, someone that you don't know, you haven't done your homework on, and so forth. Understand the purpose and the reason for getting pre-qualified and pre-approved. You have realistic pursuit of properties. In other words, a realtor is not going to show you any properties unless she knows you're fully pre-approved. Because when she makes or he makes an offer on your behalf to the seller, the sellers are going to want to know, the listing agent is going to want to know, they're all going to want to know that one, you've been pre-qualified, pre-approved, and you're ready to close as soon as the appraisal and everything comes in. It strengthens your buyer power. You have leverage. You understand the differences between what you qualify for versus what you really can afford. You understand the loan programs and how to use them to leverage your purchase. You review your credit in advance to make sure you take care of all the credit issues that might be lingering from the past, so that way you could get pre-approved and move forward with being able to make an offer. You obtain a yes or a when answer to your application. So, understanding the difference between what you qualify for versus what you can really afford. Key, the qualifying factors, the 4 C's: capacity, credit, capital, collateral. Income, capacity to repay the debt based on your earnings and employment history, expenses, number of dependents, and other obligations you have. Credit, history of how much you owe, how often you borrow, if you pay your bills on time, and if you're living within your means. Assets, capital, or the amount of cash you have for a down payment and settlement costs, as well as cash reserves to deal with repair or replacement expenses that may arise after you're in the home. Property, collateral, to protect the lender's investment if you can't repay your loan. The home you buy must be worth enough to back up your loan. So, what if factors are involved in your monthly payment? Obviously, the rates, and the rates of the market right now is a little volatile, but the rates could change on a daily basis, and it's not changing so much, but it's just up and down because of the threat of inflation currently and so forth. But we're pretty aggressive as far as rates are concerned. And there's origination fees and discount fees that could help you buy down your rate, or you could get the higher rate where you could pay towards a lender credit towards your closing costs. So the rates are key. Now, some people feel that you have to have 20% down to purchase a home. Incorrect. On a government loan or a rural development loan, you only need 3.5%, and in rural development, it's a 0%. On a VA loan, it's a 0%. But the typical down payment on a government and an FHA loan is 3.5%. And on a conventional, it would be 3% with excellent credit, or the typical would be 5%. So you also have the opportunity to work with the rates with the lender. Now, homeowners insurance and property taxes. So we talked about rates, your principal and interest, and then your property taxes and insurance. That is known as your PITI. Lenders will typically require these items to be included in your monthly mortgage payment. Typically, your insurance and your property taxes are included in your mortgage, and that is called an escrow. And while you could escrow for that, and it's mandatory on FHA loans and VA loans, you could have it waived if you choose to. I don't advise it. I think it's a good idea to have your whole payment in one, uh, all four parts, the principal and an interest, tax, and insurance, into one payment. So when the escrow is due the following year, the lender will pay it. So you have to ask which mortgage is right for you. So, of course, the mortgage options, you have conventional with 3% down, great for buyers with good credit. FHA, as little as 3.5% down, great option for first-time home buyers, flexible credit requirements. You have a renovation, which is both FHA and conventional. And in my opinion, I think you should have more experience when you're looking to get a renovation loan, because it's a tedious process. It involves getting contractors, getting bids, and so forth, matching up with the appraisal, having a consultant involved. It's a very tedious, and for a first-time home buyer who's looking for a turnkey situation just to move into your home, it could be a bit much. USDA is perfect for rural buyers, up to 101% finance. And VA loans, if you've served your country, 100% financing is available to qualified active duty veterans, reservists, and some surviving spouses. No mortgage insurance, they have a VA funding fee. So, conventional, we went over 3%, as low as 3% down, typically is 5% down. Competitive rates of 30-year or 15-year loan. If fixed rates or adjustable rates are available, and if you don't have 20% down, then you'll pay private mortgage insurance. And that's mandatory on all loans, 20% down. And that protects the lender against anything happening to the property. An FHA loan, in contrast, the down payment is about 3.5%. You could use a gift from mother, father, sister, brother. a lot of latitude with regards to credit and with regards to your debt to income ratio. So the flexibility of the credit qualifications are good. Um, and it can be used, as I said earlier, to a home improvement for renovation loan. VA loan, if you've allows an active duty reservist, veteran, and some surviving spouses. You served your country, no money down, 100% loan. There's no costly mortgage insurance. Again, it's a VA funding fee. And if you were disabled in the military or disabled after you got out, you will get an exempt from the VA funding fee. There's a limitation on the buyer's closing costs. And of course, in this case, the seller could pay all your closing. There's no prepayment penalties on a VA loan, but there's none on our FHA or conventionals either. It's a lifetime benefit. In other words, if you sold a VA house, if you have a VA loan and you sold the house and paid off the loan, you could use your VA entitlements again. A USDA loan is guaranteed rural housing uh, help to borrowers to achieve the American dream with zero down payment. Now, understand that these homes, it's not a subdivision, it's not a county. You will find them in the outskirts of town heading into the country, what is considered the country. In some cases, it's just the suburbs. Around the Beltway, you can find them in Accokeek, Waldorf, Brandywine, Malton, Upper Marlboro, La Plata, Charles County, etc. Virginia, you'll find them going on in Virginia in certain areas. But you have to look up the homes, the address, to see if they're USDA approved. Typically, the listing agent knows that and could give your agent, that information. But it's a great loan and a great instrument to purchase a house with. Grant funds. If you need funds to purchase a home and you don't have all of the monies available to you, there are grant funds. Now, the MMP, which is the Maryland Mortgage Program, is a first time advantage program that contributes 3, 4, or 5% to a prospective buyer. Now, keep in mind that there are income qualifications and there are debt to income ratio qualifications on this particular loan. So it is critical that you see if you qualify for this. Also, keep in mind that the rate that is offered with the Maryland Mortgage Program is going to be about 3/4 of a point to 1% higher than what we might give you without the grant program. Now, the grant program, there's a place for it because I've done a lot of grant program for folks that needed that part of the money. The 3%, 4%, and 5%, and the rate will go a little higher on each one of those because you're increasing the distribution and the contribution from the program. Then there's the Maryland Mortgage Program First Time Advantage, which is about $6,000 towards down payment and closing costs. So there's a menu of different types of grant programs. There's the FHLB grant option, which for first-time home buyers will give you $12,500, but you have to have at least $1,000 of your own money to contribute. And for community partners such as current or retired law enforcement officers, firefighters, employees of the state, accredited schools, employees of healthcare systems, first responders, active duty military members, veterans and their surviving spouses, and COVID-related essential workers at the time. 15,000 was allotted towards those folks. Now, keep in mind that FHLB, you have to participate as a lender in this program. We have always participated with FHLB, and they release money twice a year. So it's first come, first served. The last time we had the funds, all the funds went within a 24-hour period, and that was about 500,000. So people are waiting to take, the opportunity for this. So you have to be prepared. VHDA, any Virginia Housing, also has grant programs. Now, there's a Jumpstart program that we have. It's called Jumpstart to Home that we have at Fitzgerald Financial Group, which gives Town Bank, which gives us 100% FHA loan. So the 3.5% you would typically use for the down payment is a second mortgage. And so there's no first-time home buyer requirement. There's no household income limits. Low credit required, a minimum of 620. Flexible DTI, unlike MMP. And a home buyer education is required on all grant programs. Now, keep in mind, offers for FHAs, again, it's a 3.5%. There's two flexible options for the second loan. There's an interest-free and no monthly payments, forgivable after 10 years as long as you occupy the home as your primary residence. Or the second option is an amortized 10-year second that you will pay on a monthly basis. So the funds could be used towards down payment or closing. Also, keep in mind the rate on these two programs are going to be higher than the rate that we will give you without the aid of the Jumpstart program. Student loans. Student loans used to be a major problem. It used to be a problem, and still to this day, some lenders make it a problem by not knowing all the guidelines. It used to be that we used to have to charge or at least put 1% of whatever your student loan balance in as a debt, even if it's deferred. So if you had $100,000 worth of student loans, we had to use $1,000 as your monthly payment. If you had $200,000, $2,000. That's just to give you an idea. However, in the last 3 to 5 years, I don't know off the top, but the student loan entities have gone down to 0.5%. So it's half of whatever your balance is that you owe. And that's even if it's deferred. And some loan officers are still not counting that until it's too late and people are into the process, and then they discover that they made an error. We qualify you up front with all of this. Now, keep in mind that now income-based repayment plans are acceptable. It used to be that if you had an income-based repayment plan, in other words, it was based on your income and it was lower than typically see for student loan payments, it was not accepted. Now it is accepted. So if you have the proper documentation from your student loan company, and you can show proof that the payment is less than what we are required to give if it's deferred or if there's no payment, then we could use the documentation you have from your student loan entity. Big difference. Very important to pay attention to that. And that is applicable on all loans. Next is credit review. Well, we just went over with credit with the best in the business on everything FICO score and credit. So I'll conclude with my home buying don'ts. The home buying don'ts is kind of like a measure that you should really pay attention to this. And during the loan process, do not, or even preparing for the loan process, just live by these 10 commandments. All right. Number one, do not change jobs. Become self-employed or quit your job. Very important. Keep in mind, though, if you called me beforehand and said, hey, Mr. Joseph Sherman, hey, I've got an opportunity. I've got an opportunity to move to a better job, paying me more money and so forth. As long as you have the documentation, I'm going to say go for it. We're not trying to hold you back. But if you're making a lateral move or you're losing income, I would just, stand firm and pump your brakes and wait till the process is over. Number two, do not buy a car, truck, or van. Okay? Buying a truck or a van, getting a five, six, $700 payment in the process could deter you from qualifying. Why put yourself in that wrinkle just to get a new car? Wait till you have a house and then you could put the car in. And then you should make sure that you follow the budget and you could afford to do that. Number three, do not use charge cards excessively or let your accounts fall behind. Okay, don't assume that the credit report is already pulled and you could just go haywire preparing for the house. No, because before you close, just about every lender pulls a soft pull, okay, just to see if the bills have changed, if there are any new inquiries, and so forth. So don't do that to yourself. Number four, do not spend money you have set aside for closing. I always tell people don't take that 4-day jaunt to the islands or a week to Europe real quick and use your money and you come back with your frustrated because you had a good time but you blew it and there goes your house. Number five, do not omit debts or liabilities from your loan application. If you have a debt, it's not there, let us know. It is absolutely critical. Number six, do not buy furniture. Number seven, do not originate any inquiries into your credit card. Number eight, do not make large deposits without first checking with your loan officer. Okay, every large deposit in excess of $500 has to be explained. And it's not just a letter of explanation, it has to be paper trail. So it's critical that you don't go there and raise red flags when you're close to getting the keys to your house. And number 10, do not co-sign a loan for anyone. It is absolutely critical that you don't do this. I know relatives will be in your ear trying to bend it to co-sign for them, but right now you have to be a little selfish and look out for yourself and purchase your home. You've been waiting a long time to make this move. Secure your house, and then if you're in a position to do that, do it. If you're not in a position, don't do it. But I'm just saying, during the process, don't do it. Certainly, if you have any questions, please, I welcome the questions. If not, you're welcome to, it's in the chat, shervin.joseph@fitzgeraldfinancial.net, or you're welcome to call me. I'm always working at 571-278-8351. So, again, just give me a call. We'll take care of you. The most important thing is that you take the opportunity to bring yourself into the housing market and qualify and get pre-approved. On behalf of Sean Higgins, I'm thankful for the Washington Informer for giving us this platform so we could educate you folks. Literacy training is something we enjoy doing because, again, we know that we make an impact. We look forward to any questions you have. Again, it's important that you speak to someone that you could trust and you understand that they know what they're talking about and they have your best interests at heart. So again, for Sean Higgins, who is your everything credit guy, and for myself, we thank you for allowing us to come into your homes and just pass a little knowledge with regards to home ownership and credit. Thank you.
Thanks, Shervin. Thanks, everyone, for joining us. Appreciate it.
Thanks, Sean. Oh,